My name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. Gamma is an option Greek that provides an accurate picture of how an option's delta will change over time as the underlying stock price changes. Gamma is the rate of change of an option's delta given a $1 move in the underlying. For example, if a long call option has a gamma of 0.1 and a delta of 0.5, and the underlying moves up $1, then the option's new delta will become 0.6, all else being equal. A long gamma position is any option position with a positive gamma exposure, while a short gamma position is any option position with a negative gamma exposure. More specifically, a position with a positive or long gamma indicates the position's delta will increase if the stock price rises and decrease when the stock price falls. In other words, stock movement is beneficial for the option position. A position with a negative or short gamma indicates the position's delta will decrease when the stock price rises and increase when the stock price falls. In this case, stock movement is not beneficial for the option position. Finally, it is important to realize how gamma is affected by expiration risk. As an option gets closer to expiration, there is very little time for an option to move from in the money to out of the money or vice versa. However, since it is a possibility, an option position that is close to expiration and near or at the money can typically have large gamma values. If the underlying stock moves, this can sometimes result in big delta changes as a result of the large gamma differentials, which can quickly turn winning trades into losing trades or losing trades into winning trades. For this reason, gamma positions near expiration must be watched very, very closely. Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. Put call parity refers to the pricing relationship that exists between calls, puts, and the underlying security, as well as the strike price. Awareness of put call parity can help market participants better understand potential opportunities in the options market, as well as expand general market awareness. Put call parity is generally expressed in the form of an equation involving four simple variables: call price, put price, strike price, and the stock price. Using a simple equation, any three of those variables can be solved for the fourth. The equation is call price equals stock price minus strike price plus put price. If we take an example, imagine that a hypothetical stock XYZ is trading in the market for $30.50, and the associated 30 strike put is trading $1.10. Using the equation for put call parity, we can determine the value of the 30 strike call. Plugging in the known values into the equation, call price equals $30.50 minus $30 plus $1.10 equals $1.60. So in this example, the call price equates to $1.60. It is helpful to review the put call parity concept using real life examples by simply pulling up the option chain for a given expiration month and plugging them into the equation. The only wrinkle with put call parity is when trading longer dated options or underlyings that have associated dividends. In those cases, additional variables need to be incorporated into the equation. Put call parity allows for the calculation of the approximate value of put and call option prices relative to their components. It is best used as a sanity check of option values that are trading in the market to make sure everything looks in line.
Nasdaq-100 Volatility Index, or Vol-Q, its ticker, is a consistent measure of expected volatility over the next 30 days. And I think when we hear consistent measure of expected volatility, we often think about VIX. And there are a couple of similarities with Vol Q and VIX, mainly the 30-day outlook and using option prices to give us volatility expectation. However, Vol Q uses NDX options, VIX uses SPX options. Vol Q uses a handful of strikes that are close to where the market's trading at the time or near at the money option contracts, while VIX uses a full strip of SPX options, a lot more options going into that calculation. Due to the large weighting of just a handful of stocks for the Nasdaq-100, Vol Q has a little bit of different price behavior than VIX, and that is it tends to move up a bit in anticipation of earnings of some of the large Nasdaq-100 components, and then Vol Q tends to trend down a little bit once those earnings announcements are behind us, much like the implied volatility of options on companies that are getting ready to report their earnings. So Vol Q, consistent 30-day measure of expected volatility for the Nasdaq-100, uses just a handful of options in its calculation versus a whole strip of options. And there is some earnings seasonality around Vol Q that shows up 4 times a year during earnings season.
Hi, my name is Jermal Chandler. I'm an on-air personality at Tastytrade, and this is the Spreads Term of the Week. American-style options allow investors to buy or sell a specific asset, such as a stock or exchange-traded fund, at a specific price before a specific date. Options to buy a certain asset are known as call options, while options to sell an asset are known as put options. Options contracts are generally sold in 100-share increments, although there are some exceptions where options for lower quantities are traded, particularly when it comes to higher priced stocks. The price at which an option entitles its owner to buy or sell a stock is known as its strike price. The date when an option ceases to exist is known as its expiration date. American-style options outline the time frame when the option holder can exercise their option contract rights. These rights allow the holder to buy or sell, depending on if the option is a call or put, the underlying asset at a set strike price or before the predetermined expiration date. Specifically, an American-style option contract allows holders to exercise their rights and turn the contract into shares at any time before and including the expiration date. This is particularly handy prior to an ex-dividend date because it allows the investors to own shares and get the next dividend payment. The last day to exercise a weekly American-style option is normally on the Friday of the week in which the option contract expires. Conversely, the last day to exercise a monthly American-style option is normally the 3rd Friday of the month. When they expire, American-style options settle to the underlying actual stock price. The settlement price will usually be the last closing trading price on the expiration day. American-style options are taxed as 100% short-term capital gains. Depending on an investor's overall income and tax bracket, the taxes owed on profits would be added as ordinary income. It is always best to consult a tax advisor for more information on that. American-style options are more common than European-style options because they are used for all optionable stocks and ETFs. The bottom line is that investors need to be aware of the type of option they buy or sell, especially if they plan to trade or exercise the option on its last possible trading day.